In the last episode, we learned how the Federal Reserve uses interest rates to influence borrowing, spending, and economic activity. But what happens when lowering short-term interest rates is not enough to provide the economy with the support policymakers believe it needs? The Federal Reserve has another tool it can use called quantitative easing, or QE. Quantitative easing is a form of monetary policy in which the Federal Reserve purchases large amounts of financial assets, primarily U.S. Treasury securities and agency mortgage-backed securities. Treasury securities are essentially money borrowed by the federal government from investors. Mortgage-backed securities are investments connected to groups of home mortgages. For understanding QE, the important point is that the Fed can purchase large quantities of these assets in financial markets. These purchases increase the size of the Federal Reserve's balance sheet. A balance sheet is simply a financial record showing what an organization owns and what it owes. When the Fed purchases securities, those securities become assets on its balance sheet. As the Fed accumulates more of them, its balance sheet grows. But where does the money come from to make these purchases? You may sometimes hear QE described as printing money, but that can give the wrong impression. The Federal Reserve does not need to print piles of physical cash to purchase these assets. Instead, it can create new reserve balances electronically. Bank reserves are funds that banks hold at the Federal Reserve. When the Fed purchases a security, it ultimately pays for that purchase by increasing reserve balances within the banking system. In simple terms, the Fed creates the payment electronically. The purchased securities appear as assets on the Fed's balance sheet, while the newly created reserve balances appear as liabilities. So why would the Federal Reserve do this? One major purpose of QE is to influence longer-term interest rates and broader financial conditions. Lowering the federal funds rate primarily targets very short-term interest rates. By purchasing large amounts of longer-term securities, the Fed increases demand for those assets. Higher demand can raise their prices and push their yields lower. A yield is the return an investor receives from holding an investment. Lower yields on Treasury and mortgage-backed securities can influence interest rates elsewhere in the economy. Borrowing costs for mortgages, businesses, and other forms of credit may decline. Investors may also move toward other investments in search of higher returns, which can affect stock, bond, and other asset prices. This is part of the intended chain reaction of quantitative easing. Easier financial conditions can make borrowing less expensive and provide greater support to financial markets. That can encourage households to spend, businesses to invest and expand, and economic activity to strengthen. QE can involve trade-offs as well. If monetary conditions become too supportive for too long, inflation can become a concern. Rising financial asset prices can also raise questions about whether some assets are becoming excessively expensive, and once the Federal Reserve has accumulated a large amount of securities, policymakers eventually have to decide how to manage that expanded balance sheet. The key idea is that quantitative easing gives the Federal Reserve another way to influence financial conditions when adjusting short-term interest rates alone may not be enough. Instead of simply lowering the federal funds rate, the Fed purchases large quantities of securities, expands its balance sheet, creates reserve balances electronically, and attempts to put downward pressure on longer-term interest rates and borrowing costs. An expanded balance sheet does not necessarily stay expanded forever. The Federal Reserve can eventually move in the opposite direction. In the next episode, we'll explain quantitative tightening, or QT, why the Fed may use it, how it reverses some of the actions taken during QE, and what that shift can mean for borrowing, markets, and the economy. If you found this video helpful, please like, share, and subscribe to Life and Money for more practical, beginner-friendly lessons about money, investing, and the economy. Thank you for watching.